Here to talk about that is John Jannarone from the Herd on the Street.
How you doing?
How are you?
Good.
So we have you wrote about a company today that reached yesterday a 1.5-year high on the stock market, but you're saying that the reasons behind it may not necessarily be good for shareholders.
Well, that's right. Well, I mean, I think it's good that the stock's up. Certainly, they're probably pretty happy about that. The problem is that their potential is almost certainly limited. What happened is last week, Kenneth Cole, the chairman and founder of Kenneth Cole Productions, offered to buy the company, but he's not offering very much. It's a 15% premium, which is quite a bit below the premium you normally see deals done, which is more like 25–30%. But the issue here is that shareholders can't really do anything. They're stuck because he owns 47% of the company, has 89% voting control, and says he won't sell to anyone else. So it's basically whatever he offers or nothing. And you know, there is an independent committee that's been that the company's going to hire to evaluate the deal, but it's very difficult to get, to have a whole lot of faith in those guys, because if there's someone else out there willing to pay more, it's just, we're never going to find out.
He's got how much of the voting stakes?
89%. Yeah.
So obviously, and he's not ready to sell by any means. So
he said he won't.
It makes it tough for somebody else to come in.
But with the stock at a 1.5-year high, though, I mean, someone, I guess because there is a slight premium on the offer that he announced last week, that's kind of what's prompted the latest catalyst. But why would anyone want to be invested in a stock where you essentially have no say as a shareholder in it?
Well, I mean, I think until this happened, I mean, no one knew that he was going to do this. And remember, this isn't a huge company. I mean, his offer values the company at $280 million. Mm-hmm. But I think that, as often happens in retail, you have certain people who believe in the long-term value of the brand. I mean, Kenneth Cole himself does, right? That's why he's buying the company. But look, I mean, the company's same-store sales have been sharply negative recently. Its operating margins are almost zero. Mm-hmm. Things look bad, but there are turnaround stories all the time,
in
right?
Fact, and if you get hot, you get right. Well, we've seen this before with J. Crew.
Yeah, exactly. So J. Crew was similar. Investors were a little bit unhappy because, again, well, in that case, it was the chairman, Mickey Drexler, who negotiated a deal with a couple of private equity funds before notifying the board. Well, I think he notified them several weeks into the process, but people were upset because they thought, what's going on? He's going to stay with the company. Is he getting it on the cheap? And during that time, J. Crew had actually had some really lousy sales numbers, but again, it was probably temporary. It was an inventory issue. I mean, the value of the J. Crew brand is probably, not in trouble at all. I mean, it's private now because the deal went through, so we don't know. But
he ended up raising the offer a little bit too.
No. It was he didn't.
I'm sorry.
No, he didn't. So I mean, everyone wanted him to.
That's right. I'm sorry.
But yeah, I mean, what happened, in fact, is the stock traded above his offer price of $43.50 because people thought he was going to, or I shouldn't say he, because remember, in that case, there were private equity funds.
Right.
This is a little bit different because this is just Kenneth Cole. But the trading pattern was similar. It's just like what we have now. The stock was trading above the offer price. What I think is going to happen here is that Kenneth Cole will offer a little bit more. I mean, no one else is going to, so that's clearly what the market's expecting.
And we'll see if that turns out.